Hello, and welcome to the Individual Investor Show. My name is Jenna Brashear, and I will be your host for this evening. I want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. So, since this is my first time hosting the II show, I'd like to thank my predecessor, Kyler Wolf, for doing such a wonderful job the past few months. I have some big boots to fill, but I'm excited to take over this fantastic show. So I'd like to introduce myself a little. As I said, my name is Jenna, and I'm a new addition to the AAII team. I dabble a little in writing articles for their Education Hub, hosting our Wednesday webinar series, managing the brand new online AAII community, and of course, producing the II show. And if you have any questions for me or suggestions about upcoming topics for the show, feel free to reach out via the comment section below. After the success of our first ever virtual AAII Investor Conference 360, we compiled a few wise words from our 2021 conference speakers. For this week's show, we sit down with Brian Haughey, Christine Benz, Jack Brennan, Paul Merriman, and a few others. We asked them to spill their worst investment mistakes, share their best financial guidance, reveal how often they rebalance their own portfolios, as well as countless other intriguing questions. So, without further ado, our two interviewers, Kyler Wolf and Charles Roblett, lead this candid Q&A showcase with some of the most revered investment educators in the industry. We were humbled to be able to pick their brains about a variety of topics.
What do you feel is most useful investing guidance you can give to an individual investor?
Well, I've given that in my latest book. We're talking millions, 12 simple ways to supercharge your retirement. And if I look at those 12 ways or choices or decisions, each one is a $1 million decision. And I'm not kidding. You'll find out when you read it. But the biggest one, the most financially rewarding decision that we make is the choice of equities over bonds for the long term. I'm not talking about for an old guy like myself. I've got a lot of bonds in my portfolio, but I'm much closer to the end than the beginning. But anybody in the beginning or in between, equities is where the big payoff is. I don't mean one stock. If you get lucky and you have the right stock, that's great. I'm talking about diversified portfolio and all of those things, but just that commitment to equities is huge.
What is the biggest investing mistake that you've made or will admit to?
Well, we'll admit to. Well, there's a very long list. Warren Buffett says something like, to be a success, you only have to do a very few things right as long as you don't do too many things wrong. And I really made two big mistakes in my lifetime in terms of investing. One is, as a young person, I did what so many young people do. I took too much risk. I speculated instead of invested. I don't think that's changed one iota. I just yesterday saw a survey that shows that something like 25% of young investors think that the S&P 500 is more risky than cryptocurrency. So it hasn't changed. Young people still think they're going to break the bank and they're going to get rich quick. And then at the other end of my life, and I don't mean at the 77 years of age end, but I'm talking, let's call it the 50s and the 60s, I started getting too conservative. I have always seen list A, the good news, and list B, the bad news. Both those lists always exist. But I focused on the bad news. And when you focus on the bad, you tend to be conservative, you tend to be too defensive. And boy, did I leave between taking too much risk in the beginning and too little risk in the end. I left a lot of money on the table. But I'm not complaining where I am. I just could have done better.
What do you feel is the most useful investing guidance you can give to an individual investor?
Oh, Kyler, thanks for asking. I would say make a long-term plan and stick with it. Now, we know that people's circumstances change. And I would say if you're going to change your plan, change it in response to your life events and not in response to market events. Or to put it another way, your plan should take into account that there can be extreme market events.
And last, how do you allocate your portfolio and how often do you rebalance?
That's a great question. My husband has a little bit more taste for risk than I do. And between us, we've settled on 70% equity and 30% fixed income as appropriate for our situation. And we rebalance. There's two things that can drive us to rebalance. One is a significant cash flow in or out, an annual bonus or options vesting kind of thing. The other is that I do tend to take just an overall look at my portfolio sometime around Thanksgiving or over the winter break, and see if the market drift has warranted a shift. But there are probably months where I don't look at my asset allocation at all.
What is your favorite book written by a different author?
Again, there's so many books, but I got to focus on Peter Lynch. Actually, I'll give you two books by Peter Lynch, Beating the Street and One Up on Wall Street. Peter Lynch ran, many of your listeners or viewers probably know, but if they don't, Peter Lynch was probably the most successful mutual fund manager of all time. He ran the Magellan Fund, which at the time that he ran it was the largest fund in the US. And he still managed to crush the S&P over his 15 or so year tenure. So definitely those books are well worth watching, well worth reading, and any of his videos are well worth watching on YouTube. But I should also mention another book that's not so well known. It's called The Wisdom of Crowds by James Surowiecki. And the takeaway from that book is basically that the market is generally, but not always, more informed than the individual. So it's like Adam Smith's idea of the invisible hand. So there's a wisdom in the crowd, and so there's a wisdom in stock market. And so stock market prices are generally therefore going to be pretty accurate. And so again, you need to have an investing edge if you're going to be able to outperform, because an individual investor can outperform. Just look at Peter Lynch or Carl Icahn, but you have to do your homework and you have to have that advantage over other people in order to outperform.
And how do you allocate your portfolio and how often do you rebalance?
Well, I'm probably a little unusual here in that I don't agree with the conventional wisdom of 60-40, 60% in stocks and 40% in bonds. I'm pretty much 100% invested in equity. So there's a few reasons for that. First is that I've got a long-term perspective. You need to remember that your investment horizon is really when you die, not when you retire. And in fact, if you think about your estate, your investment horizon is really longer than that. So equities, if you have a long-term perspective, makes sense. Another reason I'm not a huge fan of bonds is because interest rates are historically low, and arguably bond markets have never been riskier than they are today. And I don't think that investors are being properly compensated for the risks that they take when they buy bonds. And remember also that the 60-40 paradigm for bonds is really predicated on the bull market for bonds over the last 40 years. And that's coming to an end, if not already at an end. But maybe the biggest reason that I'm 100% in equities is because I personally believe that we're in a 20 or 30 year bull market. I think we're finally seeing the dividend from computer technology that people have been expecting since the 70s or 80s, and that they were saying has never materialized. But I think with the growth in artificial intelligence, machine learning, with robotics and automation, with CRISPR and genome editing, I think all of those things are revolutionizing the world. Think about the voice recognition on your smartphone or your Alexa. Think about the automatic translation of Google Translate or Bixby on a Samsung phone, for instance. How you can order pizza or a train ticket without talking to a person, just by talking to a computer. Think of the productivity improvements for trucking firms, shipping goods across the country, for instance. Those firms now, as they move to self-driving trucks, they won't have to pay overtime, they won't have to pay retirement benefits, they won't have to pay healthcare, they won't have to pay vacation. So many firms, I think, are going to see huge productivity dividends. And I think we're going to see a new industrial revolution. So 100% equities is my mantra. And if I were to rebalance, I'd do it once a year.
What do you feel is the most useful investing guidance you can give to an individual investor?
I think the most important thing for individual investors to know is that nobody else is going to take care of future them. And the sooner they start investing and saving, the bigger difference it's going to make. If somebody invests 10% and starts early, it can make a difference across their life of millions in their purchasing power. In fact, they'll probably make more through investing than they make through everything else combined. So I think that's the basics and the most important thing.
What is the biggest investing mistake that you've made or will admit to?
Early on, we made the mistake of buying a condominium because we could. And it was a subsidized loan, which meant we could afford a nicer, newer place, or what we thought was a nicer, newer place, and a bigger loan than what we could have with conventional financing. And what we didn't realize was that just because we could didn't mean we should. And it was a new complex, and the builder didn't finish the complex, and we ended up losing everything. We lost our down payment, we lost all the money we put into it. The good news is we were young, right? And if you're young and you make that kind of a mistake, even though we lost our life savings, to that point, it wasn't very much money. And so that's the time to make those mistakes, right? When you're young, because you can then apply the lesson for the rest of your life, and the tuition is low.
What is your favorite book written by a different author?
I have a decent number of them. One that I always recommend is Nudge by Thaler and Sunstein. It's a book about improving decision making. There's some that will disagree with the takeaway from the book about trying to nudge people in certain directions. But I think the framework is actually still rather important for everyone to kind of understand and can be useful for decision making.
And last, how do you allocate your portfolio and how often do you rebalance?
So my portfolio that is invested in non-cash assets, i.e. the money my wife will allow me to invest, is in equities, and it is split generally across value and momentum. And it's split about 60% US, 40% international. And generally I rebalance it around once a year. Now, to be clear, I'm investing in ETFs. So essentially I allow the factors to do what they do throughout the year, and then usually once a year rebalance back to weights, to my target weights.
Okay. What do you feel is the most useful investing guidance you can give to the individual investor?
At the top of my list in terms of investment guidance would be to keep it simple. When we look at the main factors that make or break investors' plans, it's first whether they save enough, and it's second how they allocate their assets across the major asset classes like stocks and bonds. Those two things will be the major determinants of whether you hit your financial goals. And selecting investments will tend to be a smaller factor. So I would spend relatively less time on it. I would focus on broadly diversified, low-cost mutual funds, preferably index funds, and call it a day. To the extent that I have individual stocks in my portfolio, I would keep them to a relatively small percentage of the portfolio. And I know that's not necessarily popular guidance among AA, II investors, but I do think that simple is the way to go.
What is the biggest investing mistake that you've made or will admit to?
Well, when I reflect on how our portfolio has behaved, I would say that having too much cash in our portfolio has certainly dragged on our results over time. So this is cash that might come into our taxable brokerage account through bonuses, for example, or other windfalls like that. We're just a little slow on the draw in getting that money invested. It never really feels like a terrific time to put a lot of cash to work. In hindsight, when you look at that over many years and think about how interest rates on cash investments have trended down, that's surely been a drag on our results. And to me, it's a cautionary note against sort of soft market timing. So even if you're not actively switching in and out of the stock market, factors like being slow to invest cash can, in fact, weigh on your returns.
How do you allocate your portfolio and how often do you rebalance?
So my portfolio is broadly diversified. I use a variety of different ETFs and mutual funds that focus on US stocks, non-US stocks, resources, commodities. I don't have a lot of fixed income. My fixed income right now is primarily cash. So I have that liquidity. Rebalancing is the general guideline that I've learned in my research is that less is more. So the more often you rebalance, obviously if it's a taxable account, that's kind of a nightmare as far as the tax implications. So rebalancing makes the most sense. And the true rebalancing is selling something that went up, putting that money into something that went down over the last half year, 1 year, 2 years, whatever your frequency is. So rebalancing is really a courageous thing to do. It's exactly counterintuitive. Most people want to run with their winners and sell their losers. Rebalancing says, nope, sell high, buy low, which is really the adage of investing. I mean, the mantra of investing is buy low, sell high. Rebalancing says sell high, buy low. It's the same mantra, it's just been flipped. The way we say it is flipped. And it's hard to sell things that have done well and put that money into something you're unhappy with. And the reason you're unhappy with it is because it went down or it didn't go up as much. And so rebalancing helps people actually implement that whole buy low, sell high expression that it's almost like scripture, it's just, that's how investing works. But it's surprisingly hard to do it. And so rebalancing forces that. And so, do I systematic rebalance? Well, more, since I'm still kind of in the accumulation phase, I may put some additional money into something that hasn't done as well, and I still want a position in that. And so that is, but I'm rebalancing with new money. I'm not necessarily making a sale. So I rebalance maybe in a little bit more loosey-goosey way by, if I'm still committed to something that's had kind of a bad stretch and I decide to add more to it, that has a similar effect of rebalancing. And that's hard to predict how often the frequency that will happen at. But if I only had a portfolio, say of 10 mutual funds, I wouldn't rebalance any more frequently than annually.
What do you feel is the most useful investing guidance you can give to an individual investor?
Well, as a youth, I was a coin collector. And I remember somebody once told me, buy the book before you buy or sell the coin. And I thought that was tremendous advice, because essentially it told you what to look for, how to decide whether something was appropriately valued, overvalued, or undervalued. So you could carry that over into stock market research by saying, read the reports, understand what you're buying before you do so.
What is the biggest investing mistake you've made or will admit to?
Well, I certainly admit to being human because in the past, I have allowed my emotions to guide my investment decisions. And as we all know, that in this day and age of instant information, I can experience both fear and greed at the exact same moment. So I like to say that the best bit of investment advice I got from Dirty Harry, Clint Eastwood, that is, when he kept mumbling through grit teeth, "A man's got to know his limitations." So again, sort of a follow-up on what's the most useful investment guidance is not only to understand what you're buying and selling, but rather understand yourself, what will trigger you to make a buy or a sell decision.
How do you allocate your portfolio and how often do you rebalance?
Okay, so let's take the second part of the question. A simple one to answer is rebalancing. Many people do it by the calendar, for example, once a year or whatever. To me, that makes absolutely no sense. You should rebalance your portfolio whenever the market moves in a way that causes your portfolio to drift significantly from your asset allocation. Why should you let the market determine your asset allocation based on the calendar? So you can get major moves intra-year that could cause your portfolio to move out of balance, and you don't rebalance until at the very end of the year, let's say. And by then, let's imagine the market goes up in the first 6 months, 20%. You should have rebalanced, but you waited till the end of the year. And then in September, you have a crash and all the gains are wiped out. Now, could of course go the other way. But if it went the other way, you had the early crash, you missed on the opportunity to buy. To me, it makes no sense to do it on a calendar, and that's what many people do. To me, the only logical thing to do is one, you should rebalance whenever you have any new money, either going in or coming out, because that has the least impact on taxes and expenses, because you only do one trade instead of two. You don't have to buy and sell. If you're adding, you just add to whatever is the underperformer. And if you're pulling money out, you subtract from what was the best performer. And then create a rule. I recommend people consider what I call the 5-25 rule, which when I created it, it seems to become adopted. Lots of people now use it. So you rebalance whenever an asset class has moved either in absolute terms 5% from its target or 25% in relative terms, whichever is greater. So if you're at the major equity bond level, 60%, 25% of that would be 15. That's too big a move, I think. So you should target the first number, which is the 5%. So if equities drop below 55, you should rebalance, and if they get more than 65. In the sub-asset classes, say real estate, maybe you have a 5% target for US real estate. Well, I don't think you should allow it to double to get to 10 or go all the way to 0. So I recommend you use then the 25% trigger, which would be 25% of 5 would be 1.25. So you would rebalance whenever it got below 3.75 or above 6.25. So that's what I recommend people do. That actually allows you to gain the benefits of the well-documented momentum factor. So you're willing to allow a little upward drift, and that allows you to capture positive momentum without taking too much risk. And when bear markets happen, you're not jumping right in right away and buying when something falls, so you allow it to drift down. That should help as well as cutting down on taxes and trading costs. So that's how I would recommend rebalancing.
Phil's the most useful investing guidance you can give to individual investors?
Well, I always think there are there are 5 points to it. It's very quick. One is live below your means and start saving. Second is be balanced, be diversified is the third, be disciplined is the fourth, and then being cost conscious. That's how I think I would define the parameters of a successful program from when you're 21 till you're 101. Would have those 5 components to it.
The next one is, and we can use the charity one if you want to use it. What is the biggest investing mistake you've made or will admit to?
So can I give you a 2-part answer?
Sure.
The first on the numbers is being way too conservative over time. In terms of, I've been a long range dollar cost averager, which has been psychically beneficial, but in a 40-year bull market financially on an IRR basis, I've hurt myself by being too conservative in the way I invest, have invested over time. And that's fine, I'm good with it, but on the math, I should have said, I've got a 70-year time horizon. I should just put money in, I believe in the markets, but psychologically in a high risk job, subject to the markets, I systematically underperformed what I could have done had I been more aggressive. So that's one point. It's not a bad one. It's kind of like I'm too loyal to my employer when they ask what are your major weaknesses. So, but it's a real issue. The second, I talk about this in the book, anchoring to an arbitrary number and having it cost 30% of the value of a stock for the want of 1% of the value of the stock. And again, it's a case of having delayed gifting an equity in February of 2020 and seeing it worth 70% of what I could have gifted it for 6 weeks later. And it's not the money, it's the message that anchoring to an arbitrary value is a mistake. And I own up to it freely.
Great. And then what is your favorite book by a different author?
I always go back to Burt Malkiel's Random Walk Down Wall Street. I think it's such a compelling education tool for any of us. It's a re-education for you and me, perhaps. But, Burt has kept it fresh through a lot of editions, whether it's 12 or 13 editions. It's the first book on investing I ever read. So some people will think, well, it was written in 77 or 8 or whatever, but it's been continuing. And Burt is a young mind in a mature body. So when somebody asks for a book, that's the first one I give them.
We hope you enjoyed tonight's broadcast. Please remember to hit the subscribe button if you'd like to be alerted of future AAII shows. Remember to check out our website for helpful investment resources on the Education Hub. Lastly, if you'd like to become an AAII member, we offer a variety of services that can help you become a well-informed individual investor. Visit AAII.com to learn more.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look.
can watch the full AAII Investor Conference 360 as well as individual speaker replays on demand by registering at the link listed below. The C-Vend registration link is also located in the YouTube description. And with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and take care.